WeWork wants to be worth $35 billion. The CEO of Audi put in jail for fraud, and it's end of financial year. 3 tips to make sure you make the most of it. I'm David Boyer, and this is your Financial Mentor News. WeWork has announced it's chasing a $35 billion valuation. WeWork uses a really interesting accounting concept called earnings before interest, tax, depreciation and amortization, EBITDA. It's quite common, but adds back something called community cost to its underlying profit. So can you do this for your business? Well, WeWork's using this sexy type of accounting called management accounting. To do this, you need to know your costs. Nothing beats having great record keeping, but also having policies at the end of every month to know what to do with each cost. It should be noted that usually this type of reporting is done for internal purposes, to help your management and your leaders make better decisions. It probably isn't going to fly for your tax return. The next tip is to know your break even. WeWork are all over their numbers. They know what occupancy levels they need in each site in order to make a profit. Break even's made up of 3 elements: direct costs, variable costs, and one-off costs that don't really hit your profit and loss, but rather your balance sheet. And finally, communicate your numbers to your team. Everyone needs to be on the same page to know what results they're working towards. The best cultures always have specific targets where everyone's traveling in the same direction. Last year, the world was in uproar when it was announced that Volkswagen had fudged the numbers on their CO2 emissions. It's pretty obvious to not lie about caring for the environment, but last week the Audi CEO was arrested on charges of fraud which relate to poor governance. A failure of governance is when enough people in senior positions know what's happening but do nothing to stop it. There's lots of examples of it in the Royal Commission into banks at the moment. To make sure a failure of governance doesn't happen in your business, start off by having a governance structure and putting together an advisory board or even a formal board. Your board might be made up of your lawyer, your financial mentor, somebody who knows your industry inside out, and somebody who's done everything that you want to achieve in your business as well. Then you need to mandate that board with specific things you want done in your business. Once assembled, your board will have monthly or quarterly meetings and they'll assess how you're tracking against your goals and the approved strategy. If one of your goals was internal processes to make sure nobody lies about carbon emissions, it'll come up at that meeting. Having great monthly insight reports are really critical to having a robust discussion so that your board members can see what's really happening inside your business. And finally, the role of your board is to test, debate, and make sure you're implementing an approved strategy. If you want to know more about this, SQLCFO.com has an 18-page pack filled with great advice about assembling your board, working with your board, and making sure it adds value to your business. Check it out. And finally, it's end of financial year, usually marked off by the period of time where you need to report your profit to the tax office. But there's a lot you can do to make sure that your business is ready to take on the next 12-month period. To start with, be aware of the marketing messages that are out there about borrowing money from non-bank lenders to take advantage of the $20,000 instant asset write-off. This write-off allows you to get a tax deduction for things that you're buying for your business, but you get 100% of the deduction this year rather than over time. It's worth noting that this only applies to things that you would have got a tax deduction for anyway. It's not $20,000 being put into your pocket by the government to spend on things that you need to run your business. If you are borrowing from a non-bank lender, do your numbers. Sometimes you'll find that the cost of interest of borrowing the money is more than the benefit you get from the tax deduction, putting you in a worse position and costing you more cash. Always pays to do your numbers when it comes to buying assets and borrowing money. End of financial year is a chance to look back at the year that was. How did you go against your goals? To do that, you need to have great financial records. Make sure your numbers are done, up to date, and ready to go for your tax accountant to lodge your tax return, but also to sit down with your financial mentor and track where things could have been improved. It's also a great opportunity to look forward, to set a budget for next year and to work out what strategies that you've got in your head you're actually going to bring to reality. Check out your financial mentor news at SQLCFO.com for a great guide of different ways you can budget your business leading into the new financial year. Well, that's it for your Financial Mentor News this week. If you like what we have to say, check out sequelcfo.com, like, comment, and share with your friends.